Vulnerabilities have arisen because commodity markets tend to be concentrated among a few large firms, often involve leverage, and have a high degree of opacity deriving from the use of OTC derivatives. Well, here they could have said vulnerabilities arise from the bullion banks and the LBMA and the fact that they don't really trade real gold. It's all paper promises, but they don't say that, of course. Wednesday, May 21st, 2025, Monaco 64, home of alternative economics and contrarian views. Well, the European Central Bank, or the ECB, has warned that the gold market could bring the whole financial system down. And in a roundabout way, not directly though, they're saying that the leverage by the bullion banks is unraveling. It's what we've been talking about for, well, since I started this channel in 2015, and it's something that I've been looking at since 2002 when I learned about the gold manipulation. And one of the big reasons why I think this is happening is that the Chinese are rushing to get physical gold because they don't want to be left holding the bag. And that's what we're going to look at today, and what holding the bag means for the Chinese. Before I start though, I'd like to thank all of you for your interest in the channel. We're almost up to 140,000 subscribers. One thing I would say though is that a lot of you, almost half of you, enjoy my content but don't subscribe. So yeah, if you're gonna keep watching, maybe think about subscribing. It helps the channel and the algorithms. So before we go into the ECB and China, just wanted to give a heads up to my viewers in the US. This has been kind of a topic for the last few months, and I've touched upon it, and it's private equity. In the last video that I made, I said that private equity is usually for accredited investors, and by accredited investors, it means that you have to have millions of dollars of liquid assets. You have to be an accredited investor. It's not for small investors. But the problem with private equity, with what we've seen in the last 3 years, with interest rates going up and financing getting really expensive, they're in trouble because they don't, these private equity funds or private equity investments, they don't trade in the public market. They're very illiquid and they're highly leveraged. So the billionaires, millionaires who are holding a lot of these assets, they can't get out, but they want you, the public, to be left holding the bag, just like China doesn't want to be left holding the bag. We're going to look at it, and I hope a lot of you won't fall for it. This is my opinion, it's not advice, but it says here on this latest topic of private equity, and it came out 2 hours ago in the FT, Donald Trump considers order to open US retirement plans to private equity. So US retirement plans, private retirement plans, plans total like $9 trillion. Move would pave the way for savers to access funds focused on corporate buyouts and other high-octane deals. High-octane means just leveraged and a lot of debt. I said a few weeks ago when I spoke about private equity that a couple of friends of mine, they just got out of their private equity on the 1st of April, wealthy friends, and they only got like 65% of what they thought they had, but they wanted out. So just want to look at some of the comments here. Yeah. I said unsuspecting public will be left holding the bag. I commented, I subscribe. I've got 4 likes. Someone says, Westering Ho says, run away as far and as fast as you can. These guys just want to dump their ill-considered, illiquid bets on unsuspecting public. Run. So I'm going to stop right here, and we're going to go back to look at the ECB and China. Well, the ECB story came out a couple of days ago. It was on Monday. Bloomberg reported, and I have it here. It says gold markets are cited by ECB as a risk to financial stability. Well, that headline is really misleading. It's like gold is a risk to the stability of the system. No, it's fiat currency, of course, and leverage and debt that is a risk. Speculation with leverage that is a risk to the system. But let's go through this article quickly here, and then we'll look at China. Gold markets could be a source of danger to the Eurozone's financial stability in the event of geopolitical stress, European Central Bank said. Demand for physical settlement, the dominance of large-scale traders, and opaque transactions all combine to pose a wider threat if things go awry. 4 staff economists wrote in a note published on Monday that will feature in a bigger risk report scheduled for Wednesday, for today. So we're going to get some more news later on today. I'm a little bit early. It's 6:45 a.m. London time as I speak. Should extreme events materialize, there could be adverse effects on financial stability arising from gold markets, they wrote. Vulnerabilities have arisen because commodity markets tend to be concentrated among a few large firms, often involve leverage, and have a high degree of opacity deriving from the use of OTC derivatives. Well, here they could have said vulnerabilities arise from the bullion banks and the LBMA and the fact that they don't really trade real gold. It's all paper promises, but they don't say that, of course. Gold surged to a record above 3,500 announced last month in the wake of U.S. President Donald Trump's global tariffs, while it has since retreated, suffering the biggest weekly loss since November last week. ECB economists identify lingering reasons for concern. Margin calls and unwinding of leverage positions could lead to liquidity stress among market participants. Yeah, among the big banks, right? Potentially propagating the shock through the wider financial system. Yeah, that's why it's a risk. It's not gold that it's a risk. It's this fraudulent paper game, unallocated paper game that the LBMA play. And all these European banks, they participate in this. Additionally, disruptions in the physical gold market could increase the risk of a squeeze. Yeah, because there's not enough real gold to cover physical settlement, right? Because these guys are not used to physical settlement. That's why. And I'm gonna, I'll continue. There's not much left, and we'll jump to China. Demand for the metal in the U.S. in anticipation of Trump's tariffs already caused a logjam at the Bank of England's vault earlier this year. It wasn't because of tariffs. It's because they want the real thing, not because of tariffs. But anyway, and prompted a surge in Switzerland's trade surplus with the U.S. because of the need for refining to recast bullion shifting from London to New York. Delivery issues could be a source of stress in the future, said ECB economists. Well, delivery issues just means that it's a Ponzi scheme. They trade gold that doesn't exist, these OTC markets. So at the end it says here, this is the group of economists from the ECB, Mauricio Michael Habib, Oscar Schwartz Blick, Emilio Siciliano, and Jonas Wendelborn. They say market participants could be subject to significant margin calls and or have trouble sourcing and transporting appropriate physical gold for delivering in derivatives contracts, leaving themselves exposed to potentially large losses. Yeah. Well, I'm sure all of you don't have problems with margin calls because all of you hopefully have physical gold and silver for that matter. It's not just the gold market that is a risk, I would add. They didn't mention silver. So what's up with China? Well, we know that China and Russia and other countries have been buying physical golds, and that by China and other countries, I mean their central banks, their governments, and they don't care about the price. They don't care about the OTC market. They want the real thing, and they buy it for the long term. And especially since 2022, they've been buying net north of 1,000 tons each year, and they're continuing to do so. And the reason China doesn't want to be left holding the bag is because they know the dollar is on its way out, and China as a whole has like $3 trillion in foreign reserves. The PBOC, of course, has been or the Chinese government has been unwinding its holding of treasuries. It's now number 3 holder below the UK. Of course, we in the UK are going to be left holding the bag because we don't have much gold as a country. We are holding loads of treasuries, which are going to go down the drain. And I can't see the Labour government, or any government for that matter, accumulating gold here in this country. They're trying to destroy this country anyway. But aside from sovereign buying of gold and Chinese buying especially, and there are many analysts out there, of course, who have done really good research, like Dominic Frisby, David Jensen, Alistair MacLeod, who say that China actually has over 30,000 tons, the government, not the 2,300 that is the public figure. But they've been encouraging the public to buy gold as well. For many years in China, they've even changed the rules for insurance companies that they can invest up to 1% of their assets in gold. And I've got a few stories here from X. One of them is from Eric Young, or King Kong 9888, who I've had here on the channel a few times, and I'll hopefully have him on again soon. He posted yesterday, the next step is Hong Kong pension funds and MPF. I think that's the Monetary Authority. I'm not sure, MPF, buying physical gold as their compulsory asset allocation. That should slap the Hong Kong milkshake simps so hard that their heads will spin 180 degrees. So there's a story here out of Bloomberg. It says, U.S. downgrade sounds alarm for Hong Kong funds in treasuries. So there you go. That's why he's talking about the Hong Kong funds probably getting into gold. And don't forget, Hong Kong is kind of separate. It's an autonomous region of China. And from what Eric told me when I met him in London, we went out for lunch, is that domestic policy, everything's set in Hong Kong, but the foreign policy is run by the Communist Party in Beijing. So there's some more headlines here, or posts on X. Gold Telegraph says China imported the most gold in nearly a year last month despite record prices. The rush to hard assets continues. It says here total gold imports to the country reached 127.5 metric tons, a 11-month high. So not just the government buying gold, I bet you there's a lot of financial institutions doing so. Then we have by Xiaojun or Oriental Ghost talking about how the Shanghai Gold Exchange is expanding. And I reposted that and I said, move over London, LBMA, and New York, COMEX. Those are huge paper markets. These are the markets that the ECB is talking about, right? And they don't mention the Shanghai Gold Exchange. But what's happening is that the gold price setting mechanism, the biggest market in gold, is now going to be China through Shanghai. And Oriental Ghost says SGE will establish a gold delivery warehouse in Saudi Arabia for direct exchange for petroleum RMB. At the same time, delivery vaults will be set up in Dubai, Singapore, Malaysia, and Hong Kong, which meanwhile accept gold pledged RMB loan businesses or business. What else have we got here? Anything else? No, that's it. And it will be interesting to see the final ECB report on the bullion banks. Really, it's not just it is the gold market. It's where the bullion banks are, because the hedge funds usually they go long gold. It's the bullion banks that short the paper. And I've spoken quite a few times to the Gnome of Zurich, who most of you know already. I met him back in November in Zurich. And he has some interesting data about open interest. And he thinks really these bullion banks are trading for the central banks. And that eventually the central banks will cover all these shorts because they know what real money is. And that's why the ECB sees a problem, because they've been caught short. Well, the bullion banks that trade on behalf of them have been caught short. And the granddaddy of all the central banks, they could be in trouble too. And who's that? Well, it's the Bank for International Settlements in Basel, a sovereign entity in the world that is above the law, which I've spoken about many times. And I'll put a link to one of my latest videos. I spoke about it. That's done really well in terms of view. I'll put it up here and you can listen to that. So let's quickly look at the markets now. It's almost 7 a.m. London. We're going to get some CPI data for the UK. They call it inflation data. But that's part of the problem. We're not going to go over that. But the CPI is expected to jump from 2.6% to 3.3%. And they just cut rates recently. Crazy, right? No wonder you need to have gold. They're going to continue debasing the currency. And that number is a lot worse. I spoke about this in July of 2022. They revised all the CPI. This is more like 5%. I'll put another link to that video where I explain what they did. The RPI, the retail price index, is almost back up to 4.2%. At least that's the forecast. It's expected to jump from 3.2 to 4.2. And that, of course, used to be the inflation number that they used to have before the CPI was introduced about 25 years ago or so. So gold right now is at $33.18. It's up another $28. So doing well, gold. We're right near the highs. Yesterday afternoon, London time, gold just jumped. So that's quite positive. The low has been $32.85. Silver is still above 33, spot silver, but it's only up 0.2%, so it needs to catch up versus gold. We're at 33.15, high's been 19, the low's been 32.91. The Dow futures is down 150 points, NASDAQ 100 is down 106, the S&P 500 is down 25. In terms of the currency, the dollar continued to drop here. It's down 2/3% versus the yen. It's down about 1/3 versus the pound and the euro. Let's check. Yeah, dollar index is still, well, it's broken below 100. Even though I don't follow it very closely, we are at 99.59, and it doesn't look very good, actually, the technical picture for the dollar index. Let's check US Treasury yields. Well, the 10-year yield's at 4.5. The 30-year yield, the long bond, is just at 5%. So we're going to keep an eye on that. We've got WTI crude up 1.5%, trading around 63. So that's going back up. And high-grade copper is up 1% at 472. And I also noticed that platinum and palladium had a really good day yesterday. Some people are talking about breakout, but I think there's still a bit of a ways to go for platinum to really break out. It's a little bit like silver. This morning, they're down a little bit. Platinum is down 1%, palladium down 0.7%. So with that, I'm going to wish you all a very good day. Take care. Bye.